Joining us to do this is KPMG Global Head of Energy, Regina Mayer. It's good to have you here, Regina. Just a reminder that you may have to press *6 to unmute your phone. What do you say to people to help understand what we witnessed yesterday and what we are seeing happen in June?
Well, it's quite historic and unprecedented. Kind of tired of using those words when it comes to oil markets, but it really was an aberration. And I think what's important to note is that those that were holding futures contracts that were long, yes, they took a bath and they lost $37 per barrel. But the producers themselves and those that had the capacity to take physical delivery for May might have made out quite nicely in some of the funds that exchanged hands yesterday.
Regina, I want to start on the bath part of the equation for a moment. It's Julie here. Nice to talk to you. Whenever something like this happens, there are sort of rumors and there's speculation about funds that just have gotten totally wiped out. Do we know anything concrete on that front? And if there were, are there any sort of ripple effects from that?
We don't know yet, but there is speculation. There were probably some hedgers and some speculators that just got caught exposed. I mean, those that could not take physical delivery for that crude oil really shouldn't have had a position yesterday, right? Most of them got out last week. So I think they were quite exposed. And those that could take physical delivery probably put a little bit of a squeeze on them. I think there's potentially two important things that could be the fallout. Number one, the regulators will probably have a look at what happened yesterday and was there behavior that needs to be checked, or are there mechanisms, market mechanisms that need to be put in place? And then I also think the exchange itself will have to have a good hard look at itself to say, were there governors that should have been put in place to prevent the kind of crazy trading behavior that we had yesterday? But right now, we don't know any of the specifics yet.
Well, Regina, help us understand the storage picture, because I read one article that said, I think it's Cushing in Oklahoma, still has plenty, or at least about a third of its storage capacity that's unused. And 40% of oil demand is for cars and trucks. No one's driving right now. So what's the true storage picture?
Well, Cushing is a choke point for West Texas Intermediate, and that's what you saw yesterday. I mean, yes, Cushing is not full, but there is a belief that it will be full soon, and some of that storage is already spoken for, right? Storage is typically purely a logistical play, but it's become a piece of gold if you've got those storage contracts in place, and then you can use it to help manage your physical exposure. But you're right. The real issue is it's the demand destruction. And we didn't necessarily anticipate that we would be driving 50% less, 90% of the planes would be grounded. And that's where that oil goes. Refineries have cut their runs 25, 30%. The oil literally does not have anywhere to go.
Akiko, I think you wanted to ask a question.
I did, yes. Regina, let me pick up on that point. You talk about the demand destruction. I mean, I keep thinking, where the relief is on the other end. We're still seeing here in the U.S. Widespread closures. The demand picture globally is not any better. What kind of cuts are we talking about that it will take to rebalance the market given the demand picture right now?
Well, I was taking some encouragement from the June futures market, which I think is the metric that we should turn our attention to. And it was holding yesterday at about 20. I know it's dropped quite substantially today, probably 30%, and falling further. That tells me that the markets are still worried that we will not have freedom of movement and we will not see demand recover until sometime in the summer. And there's a lot of debate, right? I mean, you watch it with the states talking about who can go back to work and how we're going to have movement. So we're really not going to see demand recover in the U.S. or globally. We don't anticipate until Q4. And there's implied stock builds with the excess supply. So personally, I'm very bearish on crude price beyond 2020 and even into 2021.
Hey, Regina, it's Brian Chung here. So President Trump tweeting earlier this morning that he says he's talking with the Secretary of Energy and the Secretary of Treasury to formulate a plan to make funds available. Firstly, what would that mean based on your interpretation? And secondly, do you think the federal government through the White House should be getting involved in intervening in the market here?
I think what we saw yesterday is a wake-up call to the federal and the state governments. I mean, what I was thinking was, the Texas commission that had been looking at curtailment in the Permian might need to take action as a result of what happened yesterday. The U.S. administration, I think this is a direct call for help. So the things that they're talking about with expanding the SPR, potentially allowing the growth of the SPR by using in situ storage, basically the reserves that the companies already have, oil that's in the ground, we'll count that as part of our reserve and we'll pay for that today. And then can we create curtailments that create a little bit more normalcy so that Cushing does not become this choke point going forward? I do anticipate that the U.S. and the states might take a more decisive action because of what happened yesterday. So I'm optimistic on that front.
Regina, those of us who don't, make our living watching the oil markets, I do have to ask you, it would seem to a simpleton like myself, why don't the producers just ramp down production? Or is it that simple? Because I read another article that said, well, if you close a well, you could damage the well and it wouldn't be able to produce in the future.
Well, you've got it. You're not so much of a simpleton. So we're already ramping down production. There is a view that at least 1 million barrels have already come off. And then the big reduction has been in future production. So rig counts are down dramatically. That means we're not going to drill or complete new wells. But if you shut in some of the older wells, and they are small players operating at like 50 to 100 barrels per day, the belief is that's a structural shut-in. Likely we will never restart that well again. So that's where the industry gets quite worried. Like, it's your newer production, your newer wells. They are more efficient. They're more effective. They're more economic. Those might get shut in. It's these other wells where there is resources and we're tapping into those that if they get shut in, will probably be permanently shut in. That's the calculus that the companies have been trying to play. But going to negative 37 just ramps up the need to try to create more of a structural foundation upon which these companies can make the decisions and choices that they are already making. And frankly, last week, I was let the free markets do their thing. But as of yesterday, I think I get a little bit more troubled that it probably needs a little bit more direct intervention.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.